I'm doing 1 and 2.
Yeah.
Good.
All right. Y'all can see that, right?
Yeah. Go for it.
All right. So this is case 12, phase 2, group 7. And question 1 says, develop operating cash flow forecast for the relevant lives of each type of tanning equipment using 100% for the best case, 80% for the most likely case, and 50% for the worst case. And it says occupancy estimates for each tenant option assumes straight line depreciation and tax of 30%. So as presented in the chart above, the monthly depreciation for the best case, most likely case, and the worst case on the dome is $138.33, and the bed is $50. Question 2 says calculate and comment upon the accounting, cash, and financial break-even sales for the dome unit and tanning bed unit. For the dome unit, accounting break-even is calculated through using that formula. So fixed cost plus depreciation and divided by revenue minus variable cost. And using that formula, it comes out to a total of break-even of 2,739 units. For the cash break-even, is calculated using the fixed cost divided by the revenue minus the variable cost, and the total comes out to 2,145 units. For the financial break-even, it's fixed cost plus operating cash flows when net present value equals 0 divided by revenue minus variable cost, and the total comes out to 2,722. For the bed, it's going to be the same. Actually, yes, it's going to be the same formula, and it comes out to a total of 2,134. For the cash break even on the bed, it's going to be the same formula as the cash break even of the dome. It comes out to 1,140 units. And the financial break even is calculated with the same formula as the dome, and it comes out to a total of 2,203.
Oh, shoot. Well, question 3 says calculate the net present value, payback period, and the traditional IRR for each tanning option under the various scenarios. What do the decision rules indicate? And so in the picture, you see the dome unit has an IRR rate of 150% on best case, 111% on most likely, and 51% on worst case. As for the payback period, the best case is 0.67, the most likely case is 0.90, and the worst case is 1.89. And for the bed unit, the IRR for the best case is 313%, most likely case is 217%, and worst case is 81%. For the payback period, the best case is 0.32, most likely case is 0.46, and the worst case is 1.17. So the dome unit has a greater NPV, whereas the tanning unit has a smaller payback and a larger IRR. Greater NPV, lesser payback, and higher IRR should be approved according to the decision rule. When faced with the mutually incompatible circumstance, such as this situation, where we must choose between a dome and a bed, we should make our decision based on the NPV. All right, question 4. Can Jenny evaluate this business project by assuming just a one-time purchase? Why or why not? What other evaluation methods should Jenny use? We say Jenny cannot evaluate this business project by a one-time purchase because of the life of the unit varies. We must apply the replacement chain strategy and anticipate that we will buy again after 40 years, when both will have the same life. We will also use the equivalent annual annuity (EAA) technique to analyze projects with uneven lifespan and calculating the NPV per year.
So question 5 asks, if you decide to use the replacement chain method, how does the calculation and decision change? So by using the replacement chain method, it shows that the dome is clearly superior to the bed unit. This is due to the unequal lives, that the dome has a better life. And it is evident that the equivalent annual annuity would be the evaluation method of choice. And here we can see the NPV of the dome is higher than the bed unit.
What are some externalities, side effects, and other relevant issues that could affect the decision? So some of these include a depletion of environment and other emission problems that occur with running a salon and spa, waste management that must occur with running a salon and spa. This is why public safety, along with environmental sustainability and governance scores, are essential. Loss of customers who prefer not to go to a salon or day spa and rather use natural resources is something else that could affect the business. One thing that is very relevant in today's society is the reviews that the salon and spa has on various online sources, which are other relevant issues that could affect the decision. Side effects can include certain skin disorders or infections that can occur if your salon and spa equipment is not cleaned properly. So those are some side effects that can occur. Local competition can be another relevant factor in prosperous business. If you charge more for your service should also be better. So knowing your customer base is important in regards to how much income your customers have and how much they can spend. So do you want to offer a more expensive service or a cheaper service?
Question 7, based on your analysis, which of the two units is too hot to handle and why? So based on our analysis, we came up with that the tanning bed is too hot to handle. Although it is cheaper, it is less productive because it has a shorter life compared to the dome. And the difference in operating costs of the bed unit are not large enough to offset the higher revenues generated by the dome unit. And if we look at long-term revenue, the dome unit is a better option.
That's it. Stop share and then stop recording.